What are foreign investors thinking?
For the most part, you will see, in 16 calendar years, 11 times India has big positive net flows. Emerging markets, we've gone literally practically from $0 to $3 billion in the last 4 years. India as an asset class, it was actually becoming a single country asset class on its own. We were seeing a lot of interest in India, and India rewarded people very, very well.
Last time, Aashish took us through 25 years of building and a bookshelf that describes how he is. This time, we go into real money questions. Welcome to the second episode of the Wealth Insight podcast, Aashish.
Thank you.
First, when I look at equities itself, right? You all started off as actually a PMS and AIF house, which used to run long only equity strategies. What in your views are better served in equities if I have to do it through a PMS and AIF route versus a mutual fund route?
Mutual fund, obviously, over the years, we've seen it becoming a mass retail product. I mean, from as little as 100 rupees to hundreds of crores. Literally everybody can invest. It's a product for everyone, right? But given that now we have 6 crore unique mutual fund investors, and mutual funds have played a role in financial inclusion and kind of pretty much reached the hinterland, of course, the regulator has been laying stress on standardizing and simplifying what mutual funds can do. So much so that what is large cap, what is mid cap, what is small cap, where the fund can or cannot invest, what each of these definitions are, right? Everything is standardized, which means that mutual funds become very standardized, very straitjacketed, and the latitude that they have to construct strategies is kind of regulated, right, and narrowed down. When you look at AIFs, I mean, everything that we can't do in a mutual fund, I think we should be doing in an AIF. Say, for example, investing in illiquids. Like when we create portfolios which are full of micro cap and small cap, we prefer to do it in an AIF rather than an open-ended daily NAV mutual fund. When we do unlisted, say pre-IPO, right? Like say when we invest in another illiquids, like say portfolio full of REITs and InvITs, for example, right? So whenever we are doing stuff which is either unlisted or illiquid or a risk profile not suitable to retail investors, that is best done in AIFs. And beyond what I just said, of course, venture capital, private equity, lending to real estate companies, credit, right? All of that is best done in AIF. Coming to PMS, I think 14% of the market cap is still with what we call non-promoter, non-institution, which means that despite so much growth of mutual funds and AIFs as well, the fact is still that almost 14 to 15% of our market capitalization is still directly held by individual investors in their own demat accounts. So many people have a history of managing their own portfolios. And if you are somebody who has a demat account and who prefers that your portfolio is managed by you yourself, then over a period of time, you can also hand out part of your portfolio to a professional fund manager to whom you are giving power of attorney or discretion to transact on your behalf. And then a PMS is a bilateral agreement, which means what the portfolio will do or not do, right? What type of fee will it be charged? Will it be fixed fee or variable fee? Right? There's no definition of what is large, mid, and small. Right? It can go anywhere. It can have as less as say maybe 10 stocks. Right? Mutual funds, of course, have a benchmark and hence some diversification and relative construct. In a PMS, you can literally be agnostic to benchmark. You can have a portfolio of 10 small cap stocks. How does it matter? Right? So I think each of them is for a different purpose. Caters to different set of requirements and risk return combinations. By and large, I think mutual fund is the most standard, most scalable. The other two, of course, are more related to individual requirements, and less standardized, the better.
So on equities itself, right? If I'm playing it through PMS or through AIFs, do you think the scope of creating alpha is greater? In the last 2 years, we've not made any equity returns. So do you think these instruments would have given much greater alpha because you get more concentrated?
Now what happens is that when you look at a mutual fund, you see 2024 when the market peaked till now, mutual funds have done very well on a relative basis. But 2023 to 2024 or 2020 till 2021, when they were like rip-roaring rallies, right? In 2020, 8,700 Nifty next year became 18,500. Then you go back to 2023, 16,600 Nifty when Silicon Valley Bank happened, 16,600 next year became 26,000. So what happens is that when there is a rally in certain sectors or certain segments of the market, and PMSs or some of the AIFs have no obligation to run a portfolio which is relative to certain benchmark or diversification norms, and so they don't have any definition of what is large, mid and small, right? So they can effectively participate. So anybody who is in the segments of the market which is tailwinded, they will do very, very well. But a mutual fund, let's say flexi cap mutual fund benchmark to BSE 500, right? They're not going to make their portfolio either growth or value. They're not going to make their portfolio such that it buys all the railway, defense, PSU infra at the cost of IT and banking, right? I mean, yeah, IT is 9% of the benchmark. Maybe I'll be 5-6%, but making it zero will be a huge risk because ultimately I have some relative performance criteria to be kept in mind. So what I've seen is that when there are big rallies in narrow segments of the market, when just stock picking works, right? Or when participating in certain segments or momentum or certain sectors or certain factors is playing out, then PMSs or AIFs or even direct equity investors, they tend to do very, very well. But when the market becomes like 2024 to 2026, there's no clear trend, right? Across sectors, some stocks may be doing well, some may be doing badly, and the stock picking will really matter, and diversification really matters. So what happens is that there are certain phases when it looks like benchmarked products like mutual funds, they look like laggards. But then over the cycle, because there is some discipline imposed on them, they tend to come back, right? So I would say that some of these, PMS, AIF, they can be more high risk, high return propositions, whereas mutual funds are a bit more centered and a bit more balanced.
So taking to your point, because you mentioned PMS and AIF can be a high risk, high return thing. So what should a client be aware when he's getting into such sophistication? Because your level of sophistication is higher. So what should he be aware of the risks when he's taking exposure to certain PMS and AIF?
See, when you're looking at a PMS or a AIF, you should keep in mind that what is this, where does this manager generate return from? I mean, what is the strategy actually all about? Like when you ask me about, say, how we manage mutual funds, I said that we are not trying to generate alpha by betting on any style, sector or factor. We are balancing for all style, sector and factor and only creating active weight at a stock specific level. So which means you can imagine that if the benchmark is X, then we will be in some respectable range, right? But
so you will have exposure to all sectors.
Yeah, we'll have exposure to all sectors and our, the kind of amplitude of alpha. So if X is the benchmark return, then when we are ahead of the benchmark, we will have a positive. When we are behind the benchmark, of course, it will be negative alpha. But the positive to negative, the amplitude is reasonably narrow, right? And you're managing more for consistency and you're managing for low volatility of alpha with some positive alpha, right? But when you look at a PMS and AIF, especially a lot of the PMSs which have concentrated portfolios full of small cap or all of those, then you should know that don't keep looking at Nifty because the amplitude of variance from Nifty will be extremely high. Sometimes you will be 20% ahead of the market, but be prepared that sometimes you will be 20% behind the market also, correct? So when PMSs, AIFs, they can have huge deviation from benchmark and hence the outcomes can be very different from the benchmark. On the positive side, it may all look good, but every once in a while, you should be prepared for falling far away from where the market is.
I wanted to take it to the other categories of AIF, and you mentioned, which is more of the private assets part, category 1 and category 2 AIFs. We have seen a huge allocation of that from HNI, UHNI investors. In your view, where are the opportunities in that segment? And what should an investor be wary? I think illiquidity is something which investors don't realize in these instruments. And it's only after the cycle raising has taken, they realize the illiquidity. But one, where's the opportunities in these buckets? Because it's a very broad range, private equity, private credit. Where's the opportunity? And what are the risks they should be wary?
I personally feel that anybody who is a long-term equity investor, anybody who is a risk-seeking investor, I think they must invest in private equity. I mean, of course, they should follow your advice because you will have some norms of who can take what type of risk. So all the risk profiling and all the fitment taken care of. Ultimately, anybody who's a serious, aggressive, long-term equity investor, talking of AIFs, I think private equity is one area that they should pay attention to. The reason is because what happens is that as institutions put more and more money into equity, as more and more money flows into private markets, what will happen is that the stage at which companies come for IPO, that gets prolonged, right? Today, there are companies coming for IPO at 1 lakh crore market cap, 70,000 crore market cap, right? So you can imagine that when it gets listed, then of course we have to research and we will get the trajectory of the earnings growth, correct? But when it was a nascent business, just achieving product market fit and then scaling revenues and then scaling profitability, right? A lot of that alpha or the early return might go to the private investor, correct? So if you are a long-term aggressive equity investor, then you should realize that as markets become more institutionalized, as private equity becomes bigger and bigger, you will find that a lot of alpha gets captured before a company gets listed, right? So I think illiquidity is definitely the negative aspect of it, but then obviously you should take that risk with open eyes, knowing that there is risk of illiquidity. There is also risk of failure because every company which gets invested in unlisted doesn't eventually go for IPO, right? Or doesn't get into secondary transactions. But I think the risk is worth taking. And as a market becomes more mature, private equity becomes a bigger and bigger asset class. And then, I think a lot of alpha does get captured there.
Great, Aashish. Thank you for taking us through the alternates. I wanted to go to the last section of this podcast, which is more on investor behavior. You have written actively on this, you've spoken actively on it.
Sure.
So the first question I wanted to start with was that investors always say that they are in for the long term, right?
Yeah.
I want that. Yet when we see corrections in markets like we have been seen in this, behavior shows it otherwise. What do you think is this gap between what is intention and what is your actual action you get in portfolios?
Yeah, see, clearly people are very, very biased by recent experience, needless to say.
Yeah.
So if you tell someone, and it's not like people don't invest when market is bad. Like, I was saying that when there is a crisis, you should invest and take opportunity. Yeah. But what will happen today, if you tell someone that, look, for 2 years, the market has gone nowhere. In these 2 years, we at least had a high single digit, low double digit earning growth. So market has gone nowhere. We have earning growth. So market becomes cheaper. Rupee has fallen 15%, so we become further cheaper, and India's sovereign rating actually got upgraded, right? So by all means, you can say that today market is cheaper, but past 2 year return is zero, so it's not very encouraging. So what will happen today if you tell someone that, I think we must increase allocation to equity, they will do it very grudgingly. A guy who has 1 crore to invest might put only 10 lakhs. But if you got this entry point right, Vinay, then in a couple of years, what will happen to the 10 lakhs? It will give great return. Then after seeing the great return on the 10 lakhs, you will get a check of 90 lakhs. So on 90 lakhs, you get a below average return, and on the 10 lakhs, you get outsized return. So the weighted average, right? So this is the issue. It's not like people just don't invest when markets are bad. It's just that when the markets are bad, either they don't invest or they invest very small sums. When the market goes up, it gives them a lot of confidence. They feel very positive, and then they really jump in, right? I think this is the issue. Everybody says be greedy when others are fearful, be fearful when others are greedy. I think the key point is that to be a successful investor, you should not be part of others, which behooves you to know what others are doing and then make sure you don't do that. So now think what others are doing. In 2024, the others, we're not talking about the audience but in 2024, the others wanted to put money in small cap and sector and thematic. In 2025, everybody wanted to buy gold. Today, everybody wants to send money abroad.
Yeah.
And our industry publishes what others are doing on the Amphi website every month. Yeah. So you better find out what others are doing, and then you don't do that. So I think that is the thing which is extremely, extremely important to really keep in mind.
Yeah. So one thing is that portfolios currently are down 15-20%, right? If you are a pure equity portfolio, what your advice would be for those clients?
See,
when the news is so negative.
Yeah. So I think yes, if you look at 2026 or if you look at March 2026, then yes, we saw double-digit drawdown. But if I go back to say the peak of the market in 2024 and then come here, you'll be surprised to know September 2024 peak of the market till now, index is more than 10, Nifty is more than 10% down. But a lot of the multi-cap, mid-cap we manage has still given a marginally positive return. Large cap, obviously, Nifty is down. Some of the large cap funds are down. Flexi cap is down low single digit. So the amount of noise that you're seeing corresponding to that, I don't think people have seen much drawdown. Yes, 2026 was tough. Also, people who did a lot of direct equity and bought a lot of the hot stuff, they have seen drawdowns, correct? But I think any long-term investor, my suggestion to them will be, what we spoke about behavior just a couple of minutes back. And what I would tell them is to revisit this whole thing, that, since 32 years, since India's economic liberalization, index has doubled almost every 5 to 6 years. Okay, that's the long rolling average. Now, if index has doubled every 5 to 6 years, and I tell you that last 2.5 years it is at the same place, what does that tell you about the upcoming future? Right? Somewhere all of these are mean reverting and cyclical phenomena.
Exactly.
Even if you quote from Mr. Howard Marks, if you think of a pendulum, I think right now we are on a left swing. It may swing further, but I don't think you should get upset, because the amount it swings to the left, that is how much it will eventually swing to the right? So these are macro headwinds, and like we said, once in 5-7 years these headwinds come. It's all in the passing. It's a phase. And I think people should take advantage of what is happening right now.
If you have to share a lesson from your investing journey, what's the one lesson which investors should carry with them?
So, I'll share a lesson with you as a wealth manager, as a, fellow industry participant, as an asset manager and a wealth manager. What I've seen is that, and of course investors will resonate with it. I think, the biggest mistakes are made when people have an emotional reaction, right? Since our childhood, Vinay, you must have been told many times, don't be emotional, right? Even I've been told, don't be emotional, right? So basically, people react emotionally. When they react emotionally, they make mistakes. The question is, when in the process of investing, the question is, when is it that emotions get evoked? Emotions get evoked when you're exposed to extremes.
Yeah.
Correct? So when you have extreme performances or when you have extreme experiences, you thought you should make 12%, but your money doubles in 2 years. So you become greedy. Right? You thought you should make 12% compounded, but in 2 years you got 0. So you become fearful. You are following your average asset allocation for 12% compounded. Your neighbor is buying hot stocks. That is envy. Correct? So I think as asset managers, as wealth managers, and as investors who are investing for their own long-term benefit, we should never invest in a way that people are exposed to extremes. Because when people are exposed to extremes, that is when emotions get evoked. When emotions get evoked, that's when people make mistakes. So that's my lesson, that you should never tell someone not to be emotional. You just make sure you don't do anything which makes them emotional. I think that is the key point.
Actually, that was the question which I wanted to end with, is that if for your long-term investing journey or wealth journey, what is the most common mistake you shouldn't make?
So always, invest in a way that you can tolerate the fallout and it is not going to have any serious implications. That I think is very important.
Right, Aashish, we are going to shift gears to something more fun, a rapid fire. Short questions, short answers. Are you ready?
Yes, I'll try.
Equity or debt?
Equity.
A stock you would hold for the next 10 years and not check?
My company stock. My company stock.
Great. Best financial decision you have ever made?
I think to follow my own advice. I mean, we follow what we preach.
Most overrated word used in investing?
View.
Yeah, very nice. Cash is comfort or laziness?
It is depends. It's contextual. If you really ask me, I mean, I personally feel I'm always fully invested, but it's contextual.
The market currently, you think it's closer to fear or greed right now?
It's getting fearful. It's getting fearful. I mean, the narrative is becoming extreme.
One number you check every day in the morning?
How much did we outperform by yesterday?
And if not finance, what you would have been?
I would have been a teacher, a lawyer, or a journalist.
This was a great conversation.
Thank you.
We discussed markets, alternatives, your journey, as well as investor behavior. Thank you for being on the Wealth Insight podcast.
Thank you. Thanks for having me. It's a pleasure.
Stay tuned for more on the Wealth Insight podcast, where wealth conversations come to life.